Good afternoon, ladies and gentlemen. Welcome to the Fixed Income Analysts, Inc., or as we like to refer to it, FIASI, Women in Fixed Income Conference. I'm Monica Aggarwal, Vice President of FIASI and Head of U.S. Retail and Corporates at Fitch Ratings. As we put this event together, we created an agenda that would be informative and timely for fixed income professionals and purposefully sought out, well-regarded and well-respected senior female leaders who will share their expert opinions and perspectives. I'm honored and delighted to welcome each and every one of you. I'm also thrilled to note that we have over 700 participants on the call today, making it by far our largest event. For those of you who are new to FIASI, the organization was founded in 1975 to promote diverse views and thought leadership through a highly regarded speaker and networking series. Our annual Hall of Fame recognizes the lifetime achievements of outstanding practitioners in the fixed income arena. I'm indeed excited to welcome Joyce Chang, Chair of Global Research at JP Morgan and our honoree at the 2014 Hall of Fame. Joyce needs no introduction, but for those interested, her professional bio is on our website. However, on a personal note, Joyce, you may not be aware, but you've been an inspiration to me since I started my research career at Marilyn, where you were the head of emerging markets research. Over your 3 decades in the industry, you have been a great role model with your outstanding achievements and contributions, your passion for research, and your support and mentorship to many of us. Joyce has been an important supporter of FIASI and was heavily involved in our first 2 Women in Fixed Income events, and we really appreciate her support and guidance. I would like to request Joyce to share a few words with us before she kicks off our first panel on the macro outlook for the U.S. fixed income markets ahead of U.S. elections. Before I pass it on to Joyce, I would be remiss if I did not acknowledge Ralph DeCesar, our program chair, for his immense support in putting this event together. A couple of notes. For those members of the press that are on the call, please clear any direct scores, any direct quotes with the speakers. And for those who would like to ask any questions during the panel discussions, please feel free to type them in the control pane of in the question pane of the control panel. Without much further ado, please welcome Joyce Chang.
Oh, thank you so much, Monica, for that very kind introduction. And what a treat 7 months into this pandemic to be part of this amazing event sponsored by FIASI. I mean, who would even have thought that you would get 700 women in fixed income and their allies to join this call? So I wanted to say a few words about my own experience with FIASI. I started coming to FIASI events back in the 1980s, in 1989, when I was still a grad student and starting my career at Salomon Brothers. And through FIASI for 32 years, I have been able to stay connected with personalities who have really been the key thought leaders in the industry, whether it was Marty Leibowitz, who actually ran research at Salomon Brothers back when I was hired, or James Grant, or Mohammed Al-Arian, Michael Bloomberg, who's been honored, or just the core academic figures who have just done so much of the foundation that we've used in looking at bond markets, like Harry Markowitz, who I had the great honor of being inducted into the Fixed Income Hall of Fame with it back in 2014. And what I have always appreciated about FIASI's mission is that it has always aimed higher in the intellectual rigor, incorporating lessons learned from history, and incorporating all of the academic literature and foundation in its commitment to excellence. It's also one of the very few places where you can connect with a lot of senior women in the bond market. So I think for all of you who are new to this organization, I hope that you join. The only thing that we're missing tonight is having cocktails after this event. I also want to recognize a few people before I turn to the audience survey, which is a lot of fun to go through the results. I also have to thank Ralph DeSister. He has been just key in the Hall of Fame and in the Women in Fixed Income events. And what I do know in just chairing the women's organization for JP Morgan's corporate investment bank is none of this works unless we have men as allies. And a real thank you to Monica for all of the work she's been doing behind the scenes on this, and to Erin, Lyons, and Emily Paulino from CreditSights. We definitely know who has the toughest firewalls and the most secure firewalls in the region, in the industry. So I apologize that I'm not able to get my video feed to work through. But the first fixed income event that I attended for women in fixed income was just a small round table over dinner with a handful of people. This went to 100 attendees at the second event, and to have 700 is really just truly amazing. So before we go to the macro panel and introduce just an exceptional group of speakers, I want to turn to the audience survey and have Emily pull it up. So we sent around and we got a lot of responses for 6 questions, and I just wanted to walk through the survey results to set the mood. So let me go to the first survey question. So when do you think a COVID-19 vaccine will be available to the global mass population? Well, more than 80% don't think this is until, it happens by the end of 2021, but less than 10% think it's a first quarter event. So that's interesting because it feels like just the positive news on the vaccine is something that markets remain very, very focused on. And then there is more than 10% who still think this is beyond 2021, as we are talking about all the fears of a second wave. Let's now turn to the second slide. So looking at the second slide, what is your base case for the U.S. elections? Well, we already have 32 million votes that have come in, on October 20th. But this is really interesting because I've conducted the survey at a number of places, divided. Biden presidency, split Congress, Republicans keeping control of the Senate is 61%. Most of the other surveys, and it kind of shows the nature of fixed income being more conservative, have been looking at a Democratic sweep. Democratic sweep, 28%, and the status quo, only 11%. Let's turn to the next slide. If the November U.S. elections are contested and neither candidate concedes, and no winner is declared by the December 14th deadline, which is the Electoral College deadline, the state deadline is December 8th, how do you think the S&P 500 will trade in the days following the election? So down 10%. So now there is a view, even though we think it's a split Congress, that if it's contested, though, you could be down 10%, and that is held by about 60% of the audience. 30% thinking that it would be down 5%, and very few thinking that this would be a neutral event. So key things to watch as we are in the 2 weeks before the election. Now you turn to the next slide, the biggest risk. What do you see as the biggest risk in 2021? Well, overwhelmingly, 53% think it's a double-dip recession, 19% think it's a market correction for the S&P 500, risk of there being just a massive spike in rates or a inflation spike, only 17%, and trade tensions, which have dominated the headlines for the last 2 years, only 9%, weaker dollar barely making it currency war on the screen at only 2%. So let's turn to the next slide. And so here we are coming to just the dilemma that we're at as bond analysts in the current era of exceptionally low bond yields. How are you addressing the 60-40 problem? And just taking a look at JP Morgan's global government bond index, there's now $31 trillion of fixed rate sovereign debt, 76% of the debt that actually has a negative yield after adjusting for inflation. That's more than the number that we were looking at 2 years ago. And in aggregate, after you adjust for inflation, 70% of global sovereign debt has negative real yields. So how are you addressing this? Well, people are not taking less risk. Taking less risk overall, only 25%. Looking for the alternative asset classes, 34%, hybrids, alternative assets, private equity, have not changed anything, only 17%, and increasing equities, decreasing bonds, 24%. So it's those alternatives that everybody is looking at and still keeping the risk appetite. So let's turn to the next slide. When will the Fed first hike interest rates in this cycle? Well, 35% think that this is in 2023, and then we have almost another 25% who think it's 2024, and then we have another aggregate more than 10% who think it's after 2025 and beyond. So those who think that this could be a 2021 event, only 5%, and those who think that this is 2022, you have that this is a higher number than what you would see in an equity audience. I mean, you have that more than 20% think that it's going to occur in 2022. So let's go then to the final question: which asset class is going to outperform in 2021? And given that I started my career in emerging markets, so I see it again, emerging markets, more than 35%. This is very interesting to me that there's a feeling from this group that investment grade is going to outperform high yield. Investment grade, then high yield, and then loans at the bottom. So it's not necessarily even all about the yield. So the emerging markets one is intriguing, a lot to talk about in this panel. So let me now turn and introduce the panel, and it's just such a privilege to be with this amazing group of women, and some of them I have not actually had the chance to interact with as much, but just such distinguished backgrounds. And we're the macro panel, so I'm going to lead off with Michelle Meyer, who is Managing Director and Head of U.S. Economics at Bank of America Global Research. She previously worked at Barclays, also at Lehman Brothers, and she is co-chair of BofA's Women's Leadership Council as well. I see her frequently on TV all the time. And Michelle, I'd like to just start with you and just say, now that we've seen the audience survey results, do you expect a post-election stimulus irrespective of the winner of the U.S. presidential elections? Because there seems to be a market view that we will very quickly get a front-loaded stimulus package. What would be the implications of a split Congress versus a Democratic sweep looking at the survey results? And then just more broadly on the macro front, do you think investors should be more concerned about the inflation outlook? Is there too much complacency here? And how are you seeing, the labor markets, the consequences of running such high deficits and high debt levels, and the risk of a double dip into early 2021?
Great. Thank you, Joyce. It's an honor to be on this panel. It's an honor to be able to speak to you and Priya and Marilyn. So thank you very much. So lots to go over there, a lot of great questions. I'll start with the first one, which I think is really what markets are keenly focused on right now, which is what's the outlook for stimulus? The headlines, continue to be volatile. We're currently at a point where negotiations are ongoing. Pelosi and Mnuchin are making progress. There is a deadline for the end of today to come up with some sort of resolution. The big hurdle being, of course, whether or not it can go through the Senate, where there's been a lot more resistance of passing a fairly large stimulus. So there's some possibility we get something before the election. At this point, it's probably a low probability of that. More likely is that stimulus comes thereafter, most likely after inauguration. And it's not because there's not an economic need for stimulus. I think both sides would agree, particularly around helping the part of the economy that was hit the hardest, the large number of unemployed folks out there, over 12 million people that are still receiving unemployment insurance. The only $300 a week gets you to about 35 to 40% of replacement income. That's not sufficient in keeping up consumer spending trends. So, increasing that by 300, 400 in terms of extended benefits gets you closer to 100% replacement income. So there's general agreement on that. There's general agreement to help small businesses. So I think both sides can get there as well. There's a disagreement over state and local aid. There's a disagreement about some of the liability protection for companies. But again, these things are in theory able to be worked out, if not for the fact that we are days away from presidential election, and then one that we may not have a result for one that may be contested, which makes it harder to get legislation through in the lame duck, for example. So again, more likely than not, our assumption is that the stimulus occurs after inauguration, with some possibility it happens more earlier than that. So what would it look like? Under a blue sweep, we think it's the largest dollar amount of stimulus. It can be close to $2.5 trillion as the upper bound, I think, with a pretty hefty dollar amount going to state and local aid. Under a Biden presidency, but status quo in Congress, so Senate remains under Republican leadership, it's probably the smallest stimulus. That's where you have most possibility of gridlock. And it could be a sub $1 trillion stimulus package at that point. And then, Trump presidency, either with a sweep or divided, would be somewhere in between. But you have to think about both the timeline for that stimulus and the dollar amount of it. And I think it very much is a function of what happens around the election. I think that the second question, Joyce, do you mind reminding me that the second part of that question?
Well, so in the survey, quite a lot of complacency about the inflation outlook. Is there too much complacency here? And then unemployment, and just longer term consequences from just the ramp up we are seeing in the fiscal deficit and the debt numbers. What's the fallout from this?
Okay, yeah. So first on the inflation trajectory, I think this is a fascinating part of the outlook right now, and I'm sure Priya will have plenty to talk about in terms of how markets are pricing it in. But generally speaking, it's a highly disinflationary environment today, in that we've had an incredible demand shock, right, with an exceptional amount of unemployment, which should continue to exert downward pressure on wages and create some challenges in terms of constrained budgets in terms of generating higher inflation. That said, there are transitory and short-term factors that are working to drive up inflation. And I actually think the Fed's core PCE index, which is their gauge that they target, could get to their target or slightly above by next spring for a few reasons. One, the good side of the economy is seeing some inflationary pressure because there's been so much demand shifted to buy things again, from an experience to a goods-based economy. So people are going out buying homes. They're going out buying autos. They're buying household appliances. Go out and try to buy a new refrigerator. You're probably going to have a few-week delay. So there's a shortage of inventory in a lot of these areas where there's been such big increase in demand. And simple economics, demand is outpacing supply for a period of time. That's pushing up prices. Production will ramp up. It will respond. But in the interim, you are seeing some upward pressure on prices for the good side of the economy. And then I think just the base effects, right? You're comparing to last spring to next spring. That's going to push up year-over-year inflation. So we could get to the Fed's target by the spring of next year, but we very much think it will prove to be fleeting. It is a short-term move, and core inflation will head back down, probably ending next year at around 1.5%, and remain at a pretty low pace until we get to full employment, until we get to a tightness in the labor market akin to what we had at the last cycle when we started to see inflation move up. Now, another important factor is what happens on fiscal policy, which Joyce, you alluded to, and how that has an interplay with inflation. So at the moment, I would argue that the fiscal stimulus we're seeing is more stabilization policy. It's more of an offset from the private sector not producing enough than it is a government really overstimulating the economy in any way that would create a significant inflationary push. So it depends on what we see from going forward in terms of deficit expansion. If we continue to see kind of open payment and you get money pouring in well beyond what one might think is necessary just to stabilize the economy, then that relaxes some of the budget constraints and can generate a little bit higher inflation along with a stronger economy. But with absent that, the policies we're seeing now, again, more stabilization, which means that I think medium term, it's more of a disinflationary environment. And that's why I would say for the Fed, I would take the over on the market, the consensus in the survey when the Fed's going to start hiking. 20% of 2022, I think that's optimistic. Even in 2023, I suspect the Fed's going to start moving later because inflation is not going to show a consistent move above the 2% target. And this is a Fed who has embraced this flexible average inflation target, this overshoot of 2%. They're not going to normalize interest rates. They don't want to just get off the lower bound. They want to wait until there's concrete evidence that they have succeeded on their mandate. And their mandate, remember, has changed now.
Thank you so much for that, Michelle, and for those opening remarks. And I have to just say, it's such a pleasure to be here with so many top-ranked analysts. Michelle has ranked in the top 3 in the All-America Fixed Income Research Survey for Economics over the last 3 years, recognized in Forbes as well. So, sort of with that sort of backdrop on the macro side, I'd like to introduce our next panelist, Priya, and just give you a little bit about her background. So Priya is the Managing Director and Global Head of Rate Strategy at TD Securities. She's based here in New York, and prior to joining TD Securities, she was also at Bank of America Merrill Lynch. I also worked there in the 1990s, so a lot in common here. She also worked at Lehman Brothers and at Barclays Capital. She also has had a whole history of rankings in the Institutional Investor Survey for U.S. government strategy and federal agency debt strategy, and has appeared numerous times under the agency debt category. So I would like to, Priya, turn to you and really talk more about the rates market. So does a blue wave and diminishing concerns about a contested election, does that mean that higher Treasury yields have to lie ahead and a steeper curve? Where do you think the 10-year Treasury yield will be in 1 year's time? And the first Fed hike, would you agree with Michelle that this is something that 2022 sounds way too early? Maybe even 2023 isn't going to happen. When do you think the Fed will actually hike rates? And then we've just seen, our forecast is there's net Treasury supply this year in the order of $5.5 trillion. How are you looking at this whole supply and demand equation as we head into 2021? And if the Fed needs to do more, what policy tool will they use? I know that's a lot to cover, but over to you, Priya.
Thank you, Joyce. And thanks, everyone. It's an honor to be on the panel. Thanks, everyone, for joining in. Lots to unpack here. So I was trying to take down notes of all your questions, Joyce. So let me know if I don't address any of them. I think Michelle laid such a great groundwork. I mean, for those of you that deal with strategists and economists, we try and find the one thing we don't agree with, but actually I agree with everything Michelle said. So, that's a great segue. Now we have worked together in multiple firms, so there may be something there, but let me just focus in on rate. So I'll start with your first question on the blue wave and the contested election. So I think precisely because the market is nervous about a contested election. And imagine if we don't know, the Senate, I'm actually more concerned about the Senate because a lot of the races, there are at least 5 or 6 state Senate races that I think are up for grabs. They're almost near the margin of error territory. And the Georgia race is probably going to go into runoff. So if it's 49, then are we waiting until January? So it might be a presidency not knowing, it might be a Senate not knowing. That contested election is very much in the market price. And so, when we talk about market reaction under different scenarios, I think number one, what's priced in for the outcome? And at this point, I would say the outcome of the presidency plus the outcome of the Senate, I would say almost equally important in terms of market implication. The second would be how much of that contested election is priced in. So I think when we talk about outlooks, I almost have to control one factor. So assume that we know the outcome, and maybe it's a week out. And I think there's talk around turnout being large, with, as you said, Joyce, 32 million people have already voted. If that suggests a high turnout, maybe it is not contested. Maybe it's so clear that within a week or so, when the mail-in ballots are largely counted, we can call an outcome. I'd say in that scenario, the market is running with the thesis that a blue wave is largely priced in, which is why I was surprised with our response. And I keep telling investors, you just don't know. There's a lot of, we saw in 2016, the polls were not, at least, the national polls, you can argue, were still okay. But even the battleground state polls, there's much that can happen. Turnout can drive a lot of this. Again, if it's mail-in and it's contested. So I'm actually a little heartened by our audience response that said 60% of people think it's divided government. I think the market is running with this blue wave is priced in. But there may be a certain percent. I think it's just very hard to know exactly what's priced in. I would say it's not a 100% blue wave is priced in. So if you do get a blue wave, I think the market gets concerned about supply. To your point, Joyce, there's been 5 trillion this year of treasury supply, but there's an interesting distinction. A lot of the treasury supply in March and April was front end driven. So it was bills, it was twos, it was largely actually bills, less than 1 year paper. There's not a lot of duration that the fixed income market had to absorb. Starting in May, the Treasury deliberately, so it was a proper change in strategy, decided to term out that debt. And so now we're getting a lot more long end supply. I don't think if we get another, let's say 2 trillion, Michelle was talking about as high as 2-3 trillion in fiscal stimulus, I don't think it can be all funded in bills. The Treasury is going to continue that term out process. So it's a lot of duration supply that's coming in. And so the narrative that's been building in the rates market, and that's why the curve has been what we call bear steepening, higher rates led by the long end, is the front end is kept anchored by the Fed. The long end is really this tug of war between supply and demand, and people are pricing in that supply. And so I think the knee-jerk reaction, if you do get a blue wave, and let's assume we know that response or that result fairly quickly, I think you can get a continuation of this move. But I don't think this is the start of a massive bear move in treasuries. I'll get to that in a second. But, is it we've estimated about a 20 basis point rise in the 10-year led by inflation expectations, so led by tips break-evens, is what we see in that blue wave scenario. In a contested election scenario, I've heard clients say sell everything. Well, no, when you have to manage an asset allocation book, it's a little hard to just say sell everything. I think if you do get that risk reaction that our audience poll suggested, I think the long end actually outperforms. In a split government, I think the long end outperforms. So, that's how we're sort of seeing the market reaction post-election. Now, you asked about our outlook for the 10-year, and I'm going to dovetail that with supply and demand, because the way I think simplistically about the yield curve is the front end. And now, in the learning of the 2008 crisis was forward guidance. I think that was a big innovation of the Fed. And we started thinking of front end as being 0 to 2 year. I'm going to argue under the new framework review, the front end is 0 to 5 year. And that'll probably tell you when we're looking for the first Fed rate hike, which I'm thinking late 24, perhaps even further out. But it's so far out that, I don't need to really pick a period. It's later than where the market's pricing. The market's in the March through June 2024 is where the market's priced in. So the front end is kept very anchored. Michelle walked through all of the inflation dynamics. COVID is a disinflationary shock. There's structural damage. The vaccine point concerns me. If we don't get a vaccine, as our audience suggests, till the end of 21, look at the macro. How do certain macro parts of the economy rebound? Parts of the economy that need large number of people to get together. A conference like this, which I wish we could have that cocktail hour. How do you get events like that? And that affects large parts of the economy, which will then struggle until we get a vaccine. And again, getting a vaccine, making sure it's distributed, these are all very big events or issues that we have to deal with. And that's why I think the market sort of doesn't know what to do with the demand side. I will say if you get all that supply, the argument is, well, rates will rise. But if the Fed is looking at a macro economy that's still weak, that still needs support, they're not hiking, that's going to put a ceiling across the curve. Now, the ceiling is just much softer the further out the curve you go. So if you go into the 10-year and the 30-year, now that's where your supply-demand question really comes in. What we like to geek out and call term premium is essentially our estimate of that supply-demand mismatch, if you may. I think the supply side, as Michelle walked through, we're either talking, actually in all scenarios, pretty much, we have some fiscal stimulus because the economy needs it. It's how preemptive they can be in a blue wave versus a split government where either the market forces it or the economy forces it. So we're talking 1 trillion. So I'll give you our deficit numbers. It's either a 3 trillion deficit or a 4.5 or 5 trillion deficit next year in a very large blue wave fiscal deficit plan. So that's a lot of supply. Well, what's the offset? The offset beyond the fact that the front end is kept anchored is Fed QE. And this is where a critical issue that the Fed has to deal with is what do they do about the weighted average maturity of their QE and how much are they going to buy? They've been buying 80 billion with a 5-year average maturity since March, which made a lot of sense back then because it was a market functioning issue. Now I would argue QE is about providing accommodation. So our view is in December, the Fed is going to extend the weighted average maturity. And if you get 2, 3, 4 trillion package next year, depending on the makeup of Congress, that they might actually increase that 80 billion to keep the support the same relative to the treasury market. So the Fed is the biggest backstop, I'd say, that will prevent interest rates from going higher. You asked for my forecast for the 10-year, it's like 90 basis points at the end of next year. Now, some of you might look at the market and say, we're at 80 basis points on the 10-year right now, and my forecast is 90, so nothing to do. Well, you can trade the range. Around supply events, we're seeing a concession every month build up, and I think those are opportunities. Now, we're not talking home runs of 50 basis points, but you buy at 90 and you sell at 60. There's a trade there. I think you trade that range. I struggle to see how the Fed will let the long end sell off that much in an environment where they're below target on inflation, below target on unemployment. And then my guess hopefully I addressed all your questions, Joyce.
No, thank you so much, Priya, for just taking all of those questions. So just words to remember, the Fed is the biggest backstop. And I have to say that JP Morgan's forecast on the 10-year yield, we're also at 90 bips in September 2021, about a year from now. So we do think that is the key thing to watch, but look for the extension of the weighted average maturity. Let me now come to Marilyn Watson, who is Managing Director and Head of the Global Fundamental Fixed Income Strategy Team at BlackRock's Global Fixed Income Group. And she has a wealth of experience, including working at the Bank of England before joining BlackRock. And prior to that, she was at JP Morgan, asset management, and also in the investment bank. So I think all of us have like all these parallels of different places where we have worked, but her group is responsible for really addressing a lot of the 60-40 question, providing the thought leadership, the client solutions, and developing fundamental fixed income platforms, and strategies. So a lot to ask Marilyn here, but we've seen that fixed income returns were generally positive in the third quarter, led by high yield and tips, but is the best behind us? I mean, what should one be expecting for fixed income returns going forward? And when JP Morgan looks at the 60-40 asset allocation formula, which had been reliably delivering a 10% return for the last 4 decades, we think that's down to 3.5%. So how is this changing your fixed income allocation strategies? Can spreads tighten much further than here? Priya talked about trading around the range. And we've seen massive issuance, an all-time record in high grade at 1.75 trillion is our forecast. Will that demand continue next year? How are you seeing supply and demand in high grade? And defaults, that's been less than we had expected, but the rating downgrades were fast and furious initially, have slowed down. Where are we with respect to the default risk and the downgrade risk as well? Over to you, Marilyn.
Great. Well, thank you very much, and good afternoon. So again, a lot to unpack here, and I certainly agree with both Priya and Michelle that we are in a very different environment now than we have ever been before. And I certainly agree with the view that we're going to be lower for much, much longer going forward. I also agree with the view that I think front-end rates are going to be pinned, for the near or for some time to come as well, and therefore I do think that duration risk and interest rate sensitivity and the risk that you take as you go further out in terms of maturity is something that's become increasingly important as investors look at their overall allocations, not just in rates, but also in investment grade, high grade, and other assets as well. So I think, coming back to your question around, is the best behind us and what can we expect going forward? And then our view on, the 60-40 portfolio traditional allocation and what that means for fixed income investors going forward. So first of all, we did see this year, obviously, first of all, this sort of very, very strong, aggressively risk-off scenario. We saw this dash for cash, at the beginning when investors were very concerned around the COVID outbreak. Then we did see from there onwards, though, a very aggressive recovery in many assets, and obviously particularly in certain sectors of fixed income, not all, from this huge stimulus that we saw from central banks, from Congress in the US, which was really absolutely enormous, and it really has helped to help the economic data to turn around. We're seeing continuing improved data in things such as housing starts, housing permits, things like that. But it's also really has pushed investors down the risk spectrum as well. And so I think we have something that we saw in Q3, for example, as you mentioned, Joyce, is that we did see much better performance coming from high yield, for example, despite the fact that we saw higher issuance as well. And I think there are a couple of things there. So first of all, investors have been pushed down the risk spectrum if they're trying to find yield, which they are. We have this huge demand amongst investors as we have an aging population, as investors have liabilities that they need to match. You're not getting it in terms of treasuries or other risk-free rates. And so they're being pushed down either into investment grade, high yield, other assets. And I think that trend is definitely here to stay. As both Priya and Michelle mentioned, rates are going to remain very low for an exceptionally long time, going out several years, most likely. So I think that's one dynamic. And I say, so demand, I think, is a huge, huge, huge part of this equation. You did also mention that supply, we have seen an increase in supply in the investment grade space and also high yield in the third quarter. In August, we did see some pretty strong issuance. I think probably some of this was related to pulling forward issuance ahead of the US election. It was more sort of in line what we would have expected in September, and October has been relatively light. And I think issuance going forward, probably for the rest of the year, we expect to be relatively manageable. But as Priya mentioned, we will have more issuance coming from the Fed. In Europe, not so much. So actually in Europe, when you look at the central bank issuance there, it's actually a negative overall net dynamic. And so I think the US is in a slightly different scenario there. But what that means, I think, for returns and what that means for investors is that going forward, we wouldn't expect to see the same returns that you would have seen in previous decades. So Joyce, as you mentioned, your traditional 60-40 allocation, I think going forwards, when you're looking at your fixed income portion of that, I think the overall structure and strategy around that will need to be different. This year, for example, if you had actually, just invested in a traditional way and you'd had your money in treasuries, you would have done incredibly well, exceptionally well. But going forwards now, when you're holding those assets, the yield on those, around 80 basis points for the US 10-year, less than 1.5, or around 1.6 today for the 30-year. That's not going to help you to achieve your return targets in that, in a traditional portfolio. But what I think it does mean is that you can adapt. So there are opportunities, certainly also ahead of the election, in terms of volatility that we expect in certain sectors. There are some areas where you may still see a little bit of spread compression. For example, areas of investment grade, but I do think it's moderating in terms of what we can expect to see there. Maybe in high yield, we can expect to see a little bit more still in terms of spread compression. But I think also just buying fixed income assets for carry, for income, I think is an incredibly powerful tool today. And you can find that income in areas of emerging markets, as you touched upon. You can find it in areas of securitized assets. And you can find it in, in the investment grade or high yield space. But I think it's important to really focus on the quality of those assets, to really understand the duration, liquidity, and volatility around those assets. And it's also important, I think, to hedge those as well. So at the moment, we have a slight preference to hold it slightly more in cash than typically would have in the past, partly as a hedge, partly because we do think we'll see opportunities going forwards in terms of more volatility around the election and other events as well. And then we do think, I agree that you might see some steepening of the US Treasury curve, for example, but I still think in a very aggressive risk-off scenario, then you could still see some hedging properties from duration and from the longer end of the US Treasury curve. I also think that you can use FX, such as the Japanese yen, as well to help to hedge some of these positions. So I do still think you can get the returns you're looking for in fixed income, but I think the strategies are different, and I think you can't expect to see them in terms of either just overall spread compression or overall price appreciation anymore that we have seen in previous decades. hopefully I touched on all of your questions.
Marilyn, for that. So, still places where we can find value in emerging market securitized assets, investment grade, and the high yield space. And interesting from the survey results that some of the higher yielding components were not the ones that seemed to be the most favored. I know we're running a little bit short on time, but I'm going to ask each panelist to share with us a key takeaway, either a key risk they're monitoring, or a key risk that they are hedging, or a recommendation for a top trade idea, or a hedge risk. So, Michelle, let me come back to you. What keeps you up at night?
Okay. There are so many things at the moment, actually, and not including my children. But I would say, obviously this is a highly unprecedented times, and the shock that we have seen that has hit the economy from COVID has been historic. It's displaced parts of the economy very, very quickly. And I worry quite a lot about the scars on the economy as a result of that. Right now, there's a lot of fiscal stimulus. There's a lot of money that's being thrown at it, and that's helping to probably mask what's going on under the radar. But I, suspect, there will be winners and losers in the end as any shock. And I worry about a high amount of parts of the economy that will end up being displaced, parts of services economy, the workers associated with that. What does it do to, housing markets, way people live, where people live? Things change so suddenly that I think it's just created these inefficiencies.
So a lot of key risk ahead, no room to be complacent. Priya, let me come to you. A top trade idea, or what you're seeing as the best way to hedge risk and the biggest risk?
Sure. I'm glad you didn't ask about what's keeping me up at night, because I can attest to, I don't think any of us are sleeping all that great. In terms of top trade, so Michelle talked about the risk of this longer term scarring. That's absolutely in my mind. Double dip, recession came up, but I'll highlight the other risk, which is that of significant supply, and the dealer community, financial intermediation, is constrained. And we saw this in March, where the treasury market correlations broke down, and we needed the Fed to come in with not just a small amount. They were buying 75 billion of treasuries a day. So how much has the regulatory environment on broker dealers or banks impacted the US Treasury's ability to issue that much paper? And do you get another period of market functioning? We know what the Fed will likely do, but there's a tug of war between the government issuing it, and then we find out, oh wow, there weren't that many people who showed up to buy. Dealers were left holding on to it. You get some weird price action on that front. In terms of how to trade, I go back to Marilyn. If returns are going to be lower, I'm thinking I need to put in more trades in here. So my top trade is actually, I'm long treasuries because we're near the upper end of the trading range, I think. But I'm also long tips break evens, even though we don't see inflation, precisely to Michelle's point about the shock here. But if the Fed is going to let inflation run, then the only way rates can rise a lot is when inflation rises. And the concern that people might have that the Fed might actually let inflation run. So I think if you're long treasuries, you have some inflation protection through tips break evens, and then you have some high grade spreads where, without doing any credit work of default risk, I'd say mortgage spreads to me look wide. There isn't a lot of supply. You're selling volatility in an environment where rates are going to stay in a tiny range. So the combination of three, I'm trying to take some duration risk, some inflation risk, and some spread risk to try and make up for the fact that we're in a lower return universe, probably for fixed income.
Thank you so much, Priya, and also for bringing up the whole issue of market function and where regulation, what impact that could have, because that really didn't get discussed. But a lot of the same themes at JP Morgan, just the tips break even. I mean, this is something where inflation protected assets, if you look at just sort of what the market is pricing in right now, and risks that could lie ahead, even if they don't necessarily materialize, we very much agree with that view as well. Marilyn, let me come to you, and this whole 60-40 conundrum, top trade ideas, what you're seeing is the key risk, and the audience, indicating that emerging markets could be the top performer. Does that make sense to you?
Yeah, so I think in terms of this sort of the 60-40 idea, as I mentioned, I think it's important at the moment to have more flexibility and maybe have slightly more of a barbell approach as well. So as I mentioned, we do like some higher quality, high yields. We do like some investment grade, but even there, it's not necessarily just at the sort of generic index level. We're really looking at sort of from the bottom up perspective, where we think we actually have room to see price appreciation, but also actually, some decent spread compression as well. So I think it's very, very important to actually really just understand on a bottom up perspective in investment grade or high yield, really the cash flows, the industry, the sector, and a whole host of other factors. But certainly I think holding income, I think, is key, but then hedging that out, as I mentioned, with cash or maybe long end duration or FX. And then I think, in terms of what keeps, what I think is most concerning and maybe the biggest risk is it's just the huge unknown that we have around the potential for, if we get, coming into this winter in the Western Hemisphere, sort of another very serious outbreak of COVID, and we do see further shutdowns again. It's just such an enormous unknown, and we've already seen, as Michelle and Priya mentioned, we've seen already so many measures taken by central banks, by governments, and the impact on the US economy and global trade as well. If we were to see another huge shutdown, I think is just such a big unknown that I think is a huge risk to the outlook and to our position.
No, thank you so much, Marilyn, for just bringing in the health crisis. And we can talk about the markets, but the risk of a second wave. I had a lot of meetings last week where everybody who talked about the vaccine was just talking about some of the practical issues that you have to give it in double doses. 50% of the people are not willing to take it, and that it has to be transported for certain of the vaccines under development at -70 degrees Celsius. So a lot of risk to watch that is going to keep policymakers low for long, in no rush, with their foot on the pedal, and further stimulus to come. So let me just really thank all of the panelists for their insights and encourage all of you to follow their views, but just great insights on just the long-term scarring and the longer-term cost of this, and how to actually play this in an environment that's going to endure. I'd like to turn this back to Monica, but before I do that, I want to say just one huge thank you to Lauren Mouser, who I think you all saw in the email traffics as you were confirming, but she is just somebody who holds together so many of the FIASI events, and has just through every crisis sort of kept a dialogue going with the investment community and been a real champion for this event. So thank you so much, Michelle, Priya, and Marilyn. Monica, let me turn the floor back to you.
Great. Thank you very much, Joyce, Priya, Michelle, and Marilyn, for your astute insights. A lot to consider here. I'm going to now turn it to Erin Lyons. She's the head of U.S. investment grade research at CreditSights and also a FIASI board member. And Erin will now moderate our second panel on key drivers for the investment grade high yield emerging markets and loans. Thank you.
Great, thanks, Monica, and to everyone for joining us today. I am quite impressed with our attendance, and I'm excited to dive into the topics on everyone's minds. As Monica mentioned, I'm Erin Lyons. I'm the U.S. credit strategist and co-head of investment grade research at CreditSights. Our first panel of the day set the stage for the macro backdrop, and I'm lucky to be joined today by some of the best minds and PMs in the credit business across IG, high yield loan, and EM. We're going to cover a lot, so we're going to do a little bit of a speed round to get it through everything. And you'll hear how these leaders in this space are thinking about risk and positioning. Joining us today are Monica Erickson, who's head of investment grade corporate credit and a PM at DoubleLine. We have Elaine Stokes, portfolio manager and co-head of the full discretion team at Loomis. Samantha Milner, PM and head of US liquid credit research at Ares, and today she's our loan expert. And Anupam Damani from Nuveen. Anupam is a PM and head of the international and EM debt sector team. So I think we can move right from one of the big topics that was just discussed on the previous panel into what those topics mean for credit investors. Phrase came up, I think everyone has heard it a lot over the past couple of years, 10 years even, is lower for longer. And how are you thinking about this lower for longer environment and the Fed's purchase of certain credit assets into your outlooks? So Monica, why don't we start with you to think about it from the IG perspective?
Sure. Well, I hope everyone is right on the lower for longer, because the duration in the investment grade market right now is the longest it's ever been at 8.5 years. And there is an incredible amount of interest rate sensitivity in the asset class. I think what it means, if we actually do say lower for longer, you look to see where the starting point is in yields right now. The benchmark yields about 1.8%, historically the lowest yield we've ever seen. I think that is something that we're seeing globally. So I think that I'm not terribly excited about the valuation right now in the investment grade market. And I also am a little bit concerned about the level of duration in the market and the sensitivity to interest rates. So, to be able to call where the 10-year is, which is where the market really trades off of, where the 10-year is going, I think is a difficult task. But hopefully, if our panelists on the prior panel are correct, then if we float around 1.8%, I think your best expectations for returns are kind of the carry or the yield that you start out with.
And then just on the topic of the Fed's purchases, how are you thinking about their balance sheet capacity in terms of the IG market?
Sure. So I think everyone knows the Fed announced a program to purchase investment grade corporate bonds and ETFs and high yield ETFs on March 23rd. The total size of the program is about $750 billion. As of last Thursday, they announce their purchases every Thursday. As of last Thursday, I think they'd purchased $12.3 billion. So obviously, huge amount of capacity still left. And I'm not sure, spreads, when the Fed announced their program on March 23rd, that was really the peak in spreads this year, and they have come down significantly since then. I'm not sure the actual purchases make all that much difference. It's more the signal that the Fed is sending to the market, and just the idea that the Federal Reserve is actually now, through its special purpose vehicles, purchasing assets that are in the investment grade market. And then in addition to that, providing a liquidity for companies that could not access the market and their primary corporate buying program, which we'll get into later, Erin. Companies in the investment grade market obviously have not had any issue this year accessing the market, because we've seen over $1.7 trillion in issuance. But I think the Fed involvement in the market provides a real backstop for spreads and for valuation.
So Elaine, let's shift to you for a minute. So the high yield asset class obviously provides a much higher yield than IG. How are you thinking about this low rate environment, and what are you seeing in terms of investor demand for high yield?
Well, if we take what the Fed has done, they have created a need for a reach for yield, which has created a buyer for high yield. We've had the traditional high yield investors came into the crisis pretty conservatively positioned, and were all ready and willing to jump in as the market grew and issuance happened, as long as they were doing that next to the Fed, right? The Fed has said to us, look, we're going to anchor interest rates for you. So we're going to keep, lower for longer. We've heard it 1,000 times. And we're going to provide a floor. Well, thank you very much. We're going to buy ETFs, which kind of cover a broad swath of the whole high yield market. That's unprecedented. And as a high yield investor, it was like, oh, great. You're helping us now too. That allowed the new issue market to reopen. It allows, that technical backdrop actually allows our companies to bridge the gap and to get through this period. So it brought in the investors and gave them that comfort. The way I look at it is they cut off the tail risk. If we do go back into a lockdown, which is, I think, most of our, at least top 3 fears, they've already shown their cards, and we know they have all that dry powder there ready to jump in. So when you take away that tail risk, it's a much more comfortable environment to buy in.
Right. Thanks, Eileen. And one of the things I've noticed with the Fed too is they don't actually have to do much at all. They just have to communicate that they have the ability to do so, and it basically achieves the same effect. Let's move to Samantha. I know. Samantha, let's move to you. And how are you dealing with this low rate environment in the loan space? And what are you hearing from investors as they're looking for ways to put money to work?
No, it's a great question. You know, the lower rates clearly sent mass exodus of retail money outside of the loan market. We were at one point, we were 20% a couple of years ago. Now retail is 5% of the loan market. So what's that done? It's really provided stability, actually. We are getting a lot of interest from institutional clients, though, from the hunt for yield. And clearly CLOs have been a strong driver of demand. So it definitely led to retail leaving, and we expect at some point, whether it's 21 or 22 or 23, when rates do start to rise, then we'll see the retail money come back in.
Thanks. And then Anupam and EM, how are you grappling with this low rate situation?
Thanks, Erin. First of all, I just want to thank you. What an honor and pleasure to be here and with my fellow panelists. I mean, unlike at the peak of the crises when things looked very gloomy and the Fed was announcing extensive measures for support for the US credit markets, you know, there was a tendency to given the very poor social and healthcare infrastructure and, you know, the dependence of trade, tourism, remittances and whatnot of emerging markets, there was a tendency to write quickly an obituary for emerging markets. But I always like to remember and remind people Mark Twain's quote, reports of my death are greatly exaggerated. And just to outline what some of my fellow panelists said, so outside of the unprecedented policy shift that we saw from the Fed, which helped mitigate the economic downside, we did see Fed extend out swap lines and repo lines to many EM central banks to in an order to provide dollar liquidity, so to avoid the credit crunch in those economies. And outside of you know, the Fed direct support, we did have G20 you know, step in with what was called DSSI, or the Debt Suspension Service Initiative for very poor economies. So providing some you know, debt suspension to provide liquidity. Similarly, IMF very quickly stepped in to provide liquidity support to almost 69 countries in something that was called a rapid financing instrument. So this, along with what EM central banks and governments did, which was a massive policy response, both on the monetary policy and fiscal policy side, I think helped to stabilize conditions in EM. And then going back to what Elaine said, I think as the Fed provided a backstop for US credit markets, and there was a chase for those markets and yields there decreased, and investors started seeing stability arise in EM debt markets, they started entering or feeling more comfortable to chase yield in emerging markets debt. So what it allowed us to do was, for investment grade issuers, we had you know, the market open up quite rapidly, and that was very, very positive. Having said that, so I think the Fed low rate environment clearly from a hunt from yield perspective is very important for our asset class, and I think remains and anchors the asset class to a great extent.
Thanks, Anupam. So let's move on to fundamentals. And I said it'd be a little bit of a speed round to get through everything. But if we think about COVID, it certainly had a major impact on credit profiles across all of our asset classes. And I think those have been in the most impacted sectors such as leisure, commodities, and airlines. How worried are you about the health of your issuers? And are there specifics to your asset classes that make you feel better or worse about those outlooks? Elaine, let's start with you, because by definition, high yield credits were already operating with a little bit more stress on their balance sheets pro-COVID. Thanks, Elaine.
Okay, can you hear me now?
Yep,
All right.
got you, thanks.
Okay, there's no one answer to this. So what we did see happen is those sectors that were stressed, you know, retail, energy, we saw defaults get pulled forward. You know, it was just quick and over. And now the securities that we have in the high yield market, I'm just going to emphasize how important research is, and that you can't look at that whole high yield market together. It's just not possible. You've had to look at every company just this year as, you know, in the tail end of a cycle, to recession, to credit repair, to, oh shoot, we might go back into it. And all that is taking place while at the same time, the trends are so accelerated. You know, we don't know exactly what consumer behavior is going to look like after this, but I can make a pretty strong bet that more people are going to be using Amazon and ordering things online. And probably for quite some time, fewer people are going to be going to restaurants. We can make some clear bets that supply chains still have a lot of reworking to get done. So you need to be thinking about every little thing when you're looking at a company. So to me, it's like deep dive, roll your sleeves up type of environment where you just can't say, I'm going to be in the high yield market and I'm going to be safe. I think I'm going to be in the high yield market in a very measured way, understanding the credits I'm in and the bets I'm making. You know, there's one other big underlying thing that I think is supporting some of these credits, and it's this shift from small businesses to big businesses. And, you know, the Fed did it. They opened the markets and allowed our issuers to get liquidity, and that's fantastic. These small businesses, if they didn't get the PPP or the PPP is now running out, they're out, they're done, they're out of liquidity. I think most of our issuers can come back to the market. Especially those bigger issuers that were the fallen angels or in the high double B. So they still have time to bridge that gap and they still have the liquidity. They're also taking market share, you know, as the restaurants are such an easy place to look at. As small restaurants or small retail is going out of business and we're all sitting ordering from home, those bigger companies with the better logistics are winning. So that is a positive backdrop for the companies that we're dealing with from a fundamental perspective, but it only goes so far. You have to almost try to figure out which trends are becoming norms. And, you know, this is the fastest I think we've ever seen something like this happen, and it's not going to be easy. And you need to really roll your sleeves up and understand what companies have for cash and liquidity to get them to that next level.
Thanks, Elaine. So Samantha, are you seeing similar trends from your borrowers? And if so, kind of what types of actions are they seeking to make it through this COVID period?
Absolutely, a lot of similarities with high yield. I will say specific to the loan asset class, technology and healthcare are really the two largest sectors of loans. That those are really the two sectors that you feel very comfortable with through COVID, given the enterprise software, given how mission critical and sticky that is. Another difference I would say is security. While high yield definitely has more secured bonds these days, typically, loans are all secured. We are losing some, with the loose documentation, there's some issues in terms of making sure that there's no asset leakage. But I think the good news with loans is the security. And Elaine is 100% correct. It really comes down to credit selection and having that deep team, because it's easy to be underweight in movie theaters, in retail and energy, but I think picking through those COVID direct industries like gaming, our analyst has over 20 years of experience. He's not in Vegas now, but typically he does go to Vegas. And you're thinking about cuts to buffets is one example. So even though your revenue is dropping, the margins are increasing because of things they can cut. So it really comes down to credit selection, winning by not losing, avoiding those defaults. And the defaults that you happen to be in, recoveries have been pressured. So whether that's the rise of the loan-only capital structure, covenant light, it's really making sure that you pick the right credits and that your recoveries are higher.
Thanks, Samantha. So let's stick in developed markets for a moment and go to Monica. So we know that IG companies have had the markets wide open. We've had 1.6, 1.7 trillion of bonds issued. I mean, who knew we were in a pandemic? How are you thinking about these credit profiles? Because we have seen a lot of this debt either be spent or just added to the balance sheets. How are you thinking about IG profiles right now?
Sure. Right. So this has been the largest amount of new issuance that we've ever seen in the investment grade market. And you're absolutely right. I think we're actually above 1.7 trillion now. And I think it's interesting, maybe back up a little bit about how the market opened up and what companies are actually doing with the cash, because I think that is going to be one of the critical elements going forward. So early on, as you know, right after that March 23rd date, companies came to market really to pay down the revolvers that they had drawn on, and liquidity was at a premium. So companies were very concerned about how long the shutdown was going to take place for. There was a lot of uncertainty. And so that was the beginning of the new issuance and the use of proceeds. And then it evolved into just putting cash on the balance sheet. And by, I would say probably 3-4 weeks into when the market really opened up, companies had paid down their revolvers and they were really focused on getting cash on the balance sheet. Now what we're seeing is we're starting to see tenders, and companies go out and not only pay down short-term debt and buy that back, but also go out and pay down some of the longer-term debt that they have issued even this year. We've seen, I know you know, Erin, we've seen a couple of companies come to market that issued debt in March at much higher coupons, and they're issuing debt now and buying that back at a premium and taking the loss right now and lowering their interest expense going forward. So I think that the lower interest expense going forward is a key component, but also the amount of cash that is sitting on the balance sheets right now. So far companies have behaved well. Historically, companies do not behave well. So I think it's to be seen what these companies do with the cash that's sitting on their balance sheet. If they use it for the appropriate kind of credit positive uses and don't go back to doing crazy M&A with high leverage, special dividends, share buybacks, then I think the credit situation will be better. But I think that is something that is still to be seen, how that cash is used. One other component I would build on what Elaine and Samantha were saying. We did look at kind of bottoms up and looking to see what credits have been impacted by the current shutdown and COVID-19. And it's very interesting to know, this idea that it's kind of a K economy and that there are losers and winners. Most of the companies in the investment grade market, and we did an analysis, it turns out that something like 79% have actually had very little impact or actually have benefited from the current environment. So for example, like retail is a fairly small percentage of the market, but the retailers that are investment grade are, Lowe's, Home Depot, Costco, Target, Walmart. And so I think it goes back to, you do have to look to see what is actually going on with the individual credits. And like I said, 79% of the companies within the investment grade benchmark are actually in the spaces that are benefiting, or at least not really getting hit badly by the current shutdown.
Thanks, Monica. So Anupam, let's move to EM. And when I hear EM, and I think most investors are of this viewpoint as well, you generally think like lower quality issuers, but that isn't always the case. I guess, how are you seeing fundamentals trend, and are there any particular regions that have been especially hard hit, and are you seeing government support for these particular areas?
Yeah, no, Erin, that's a really great point you make. EM is certainly not a monolithic asset class. We actually range the entire credit spectrum. In fact, the JP Morgan Corporate Index and the Local Markets Index are investment grade EM indices, and even the Sovereign Hard Currency Index is 55% investment grade. So yes, we have a whole host of issuers, be it countries or companies, to choose from, both in the investment grade and the below investment grade. So I think, like what most of my co-panelists said, I think at the end of the day, it really comes down to, country by country and credit by credit assessment. And what we are trying to do is assess the shock through three things, which is, one is the transmission channels. What were the various transmission channels, trade, commodities that got hit, what the financial buffers and policy space are in each country and within credit in terms of liquidities, and then finally through the macro policy response. And when you look at those three, clearly, there are some very fragile countries which are, the lower rated and frontier market economies that have poor, very little policy buffers or financial buffers, and they came into the crisis in a weaker position, and the fiscal outlays have been very large. Although the fiscal outlays have been large across the board, you do worry obviously more about the fragile countries, because the swift policy intervention has helped them to withstand the liquidity shock. But we do need to worry as this continues on, and as Joyce pointed out, the scarring may last quite a bit longer. Can this lead to more debt distress and financial stability risk for these countries? But when it comes to regions, when we assess these countries through these three channels or shocks, North Asia and Europe come out much better than Latin America, Africa, and Middle East. And again, if you look at Latin America, Africa, and Middle East, they're generally more linked to commodities, and in many countries, the policy space wasn't as large. And similarly, the governance in a few of them, or the response both around healthcare and policy, hasn't been that great. So clearly, a differentiation is required. The market has opened up, like I said, for investment grade issuers as well as below investment grade issuers. But investors are choosing to be very prudent when it comes to which issuer they want to really go into.
Great, thank you. Let's move on to our next topic, which are fallen angels. And it's been one of the biggest themes over the past several years, I think, in both IG and high yield. With the growth of the BBB index, you can easily see why this could have been a big problem. We've already seen more than 200 billion of bonds downgraded from IG to high yield this year. And I guess the question is, do we see more? And is it something to worry about? So Monica, let's start at the top with IG and what you're thinking about this trend.
Sure. Yeah, if you look at the downgrades, you're correct. There's been about $200 billion of credits that have gone from investment grade into high yield. On a historical basis, that is a relatively small amount compared to the size of the index. So I think I calculated it's about 2.5% of the Bloomberg Barclays Credit Index. And if you look at the great financial crisis, downgrades were around 8%. So, if we were to actually get that kind of level of downgrades, we're talking about $640 billion, which I don't think that is the case. And then going back to looking at it from a bottoms up analysis, I think there are credits that are cuspy and that we're watching. The aircraft lessors are definitely in that group, and for some reason the credit agencies have kept them investment grade. There are a couple of large structures out there. GM is one of them. Boeing is another that are very cuspy. My base case is that Boeing stays investment grade. I think they've had some positive news in the last couple of days. And GM seems to be on a trajectory of being able to keep their investment grade rating as well. But you know, a lot of it depends on where the economy goes, what happens with the vaccine, where really demand ends up. And so we could see there could be some other companies that get dragged down if the economic activity continues at this low pace. But going back to really what the largest sectors in the IG market, number one is banking. The banking credits are in incredibly good shape, came into this crisis in incredibly good shape, and have actually done incredibly well. Tech, healthcare, and pharma are the next largest sectors, doing incredibly well. Even if they're rated BBB, their cash flows are fine. They have shown to be really resilient and actually have been doing quite well through this current shutdown. So I think there are certain sectors. My base case is probably, if you do it the bottoms up, something like $50 to $60 billion of additional downgrades. And then one last thing I would point out is that I think we all talk about these downgrades, and it's like the scary thing, and oh my God, you know, the company's going to go from high IG to high yield. If you actually look at the returns, every company that has gotten downgraded this year is actually outperforming. And all of the underperformance happens prior to the actual downgrade. And then one last point about the $200 billion worth of downgrades this year. It's 3 companies make up half of those downgrades. And one of those companies, Kraft Heinz, got downgraded prior to the COVID-19 and the economic shutdown. So I think downgrades happen much more because of company-specific issues. Sometimes the economy tips it over and they end up being in high yield, but it's again, company-specific, and you have to look at it from a bottoms-up perspective.
And Elaine, so as a result of all of these downgrades, we've seen a change in the makeup of the high yield index. What are your thoughts on the fallen angels? And as Monica pointed out, like, do you think those are good buying opportunities?
Yeah, absolutely. We definitely look at this as an opportunity, and I love these markets where we get a lot of fallen angels. So the high yield market, it took in that 200 billion. Thank you, Monica. It also they came to the high yield market and then they issued more debt. And they were able to issue more debt. So we've had 350 billion in new issues on top of that. So we've had over 550 billion in new high yields. And I think it was 125 billion roughly that's defaulted. So we're still net have a high yield market that's growing. And that hasn't been an issue at all. I mentioned it earlier, there was plenty of cash on the sidelines. There was defensive positioning, and there has been no problem absorbing that. What it has done, though, is, as you mentioned, changed the look of the high yield market. The high yield market is longer now. It's, as I said, growing versus shrinking, and it's growing with some large liquid issuers. And as a high yield investor, liquidity is rare, and I love to see it. The industries are shifting. We've definitely become more COVID related, more consumer related. You know, we've lost a lot of retail and energy, but we're picking up a lot in those more consumer related sectors. It's also gotten a little bit higher quality where, you know, we've moved up. So, you know, a double B, longer, more liquid, this is like perfect shopping ground for this type of environment where you can differentiate yourself and really pick the winners. So I think, you know, right now, when I look at the credit markets, it's that triple B, double B space where that is the sweet spot to invest. You know, a lot of people refer to it as that crossover space. It's finding, like Monica said, the GMs and Boeings that get treated like they're going to be downgraded, but don't. And then looking at a name like Kraft or any of the other fallen angels and being able to say, hey, you know what, this is going to go to BB, but it's not going to go to CCC. And they have a lot of, these larger companies have a lot of levers to pull. So I think it's a great opportunity for high yield investors or for credit investors to pick up some extra yield and really to take advantage of the volatility that we're probably going to see over the next couple of months between the election and COVID.
Thanks, Elaine. And just my 2 cents on the topic is I'm hearing more and more clients are asking me if I think they should expand their mandates. So if they've been traditionally IG only, should they increase their high yield sleeve to buy more BBs? And also, there's generally 4 sellers of IG on a downgrade are getting waivers to hold the names because they do know that the buyer base is there and they're seeing these bonds rebound and they don't want to be caught. You know, they didn't sell ahead of the downgrade and now they don't want to be selling with everyone else. Okay, so let's move on to the election. And I think we had a pretty good overview of the potential outcomes in the previous panel. So I appreciate what Priya, Michelle, and Marilyn added. I'm not going to ask of you on who wins because that would be an entirely different discussion, I think. But we have the 3 scenarios, the blue wave, the Biden win with split Congress, and what's looking a lot less likely based on the polls, Trump staying in office. So I'm going to kind of start with Samantha and put you in the hot seat. What scenario do you think creates the most volatility in your market? And then along with that, what happens and how do investors react if we don't have a winner on November 4th?
You know, on the if there's a contentious election, clearly there will be volatility. And I love the outcome from the poll at the you know, at the first panel in terms of 60% are expecting, I think it was a 10% correction in the S&P. So we would expect volatility, you know, definitely in the equity market. In the loan market, it really wouldn't translate as much to the loan market, again, given to what I spoke about before in terms of retail being a smaller percentage of the market. You're not going to get that fast money, you know, if there is volatility in November and maybe even to December. You know, CLOs are really that dominant buyer. And also I'd say we have a buy the dip mentality that's really across all credit. So as soon as you do see some volatility, there are plenty of accounts, as we've been talking about, that have cash that see it as an opportunity because we hope any contentious election would really be short-term in nature. One thing I also forgot to mention about loans is we are losing a lot of paper to high yields. So we also have the supply going for us as well in terms of positive technical. And we really saw that play out in September. So in September, we saw equity sell off, we saw high yield sell off, but loans were actually up over 1%. So again, still expect volatility, but I just don't think it would be as sharp, you know, as we've seen, of course, in March and April. And if there is chaos, which isn't our base case, again, we have that Fed backstop. And while we don't have that explicit support from the Fed in loans, as we've been talking about, anything is on the table. I mean, they could be supporting equities. I mean, who knows? We never would have expected high yield to be supported. So I think the Fed has made a statement, though, that they don't want to save these over-levered, you know, CCC private equity-backed borrowers, of course, but in general, most of the asset class that I'm talking about, you know, on the higher quality side, if there is chaos, so we expect there to be some sort of intervention, but it's definitely not our base case.
Thanks. And Anupam, what are your thoughts on how to position around this volatility in the EM markets?
Yeah, so I think as an EM investor, you learn early on that elections always matter. They've always mattered in emerging markets, but increasingly in developed markets. And I think this election more particularly is of great importance because if you look at the last 4 years, emerging markets debt has, what I like to call it, been at the receiving end of Trump's tweets, erratic policy making around trade, foreign policy, you know, very protectionist policies that don't benefit EM, and really, you know, a move away from general multilateralism. And if you look at in this current environment, anytime if we can move away from that and get more policy predictability, you know, reduce trade tensions, and you know, although there's bipartisan support for conflict with China, but I think in any scenario where Trump is not back in power, I think those discussions are likely to be put in various tracks around commercial and strategic issues, where there will be you know, forms of cooperation on certain commercial issues and maybe not so on certain strategic issues. So it's not going to become like either, you know, China is good or China is bad. The other thing I think is, in any scenario, I think you're likely to see a fiscal response in the US here. In a blue sweep, clearly a much larger fiscal response, and that happening within the context of what the macro panelists were talking about. And I buy into that view, where the front end rates remain very anchored and even the back end really doesn't go up that much higher, is a very highly globally deflationary scenario where the dollar weakens. And that is quite beneficial for emerging markets debt as well. So not only from policy predictability, move more into increased multilateralism, and given the health crisis around the world, I think the global economy can use it. And given how much need EM economies have of alliances and more multilateralist approach, I think this would be quite beneficial. And like I think Samantha mentioned, if there is increased volatility, you know, around contested election results or whatnot, I think that is going to be used as an opportunity to buy the dip in the market.
Thanks, Anupam. So Elaine, we are definitely seeing investors bifurcate a bit at the sector level. We get a lot of questions on who wins and who loses under each scenario. And it's maybe less winners and losers, but which ones are more impacted with the policies on the table? I guess, how are you thinking about the sector impacts?
Yeah, you know, surprisingly, given how different the two candidates are, there are a weird number of similarities. You know, we know that we're, you know, Anupam already talked about China. We know that China is still going to be in the spotlight. We know that high quality, you know, the big tech companies are still going to be in the spotlight, and is definitely going to continue to work there. We know that healthcare is probably both a legislative issue as well as you know, a policy issue, as well as who are the winners and losers given COVID, right? So there's a lot of mixed messages in some of these, and it's not so clear cut. Okay, if, you know, maybe one or two sectors are really could potentially be hurt by one candidate versus the other. When I take a step back, I look at, you know, how have bonds returned already this year, and what I see is there's already been this crazy divergence, you know, where tech, housing, autos, some of these sectors that I don't see in the policy spotlight have done really well. 4.5%, 5.5% type returns year to date that we would all be happy with if we had in our high yield portfolios. And on the other side, you've had energy, you've had transportation, the gaming and lodgers who have all highly negatively or very negatively performed, you know, with energy as low as down 20%. So the market to me has already priced a lot of that in, and it did that relatively early on. And now what it's doing is pricing in a Biden win. And I don't think it matters as much in the next year or two, whether it's a sweep or divided, because the feeling is Biden's more predictable, stable. You can guess that he's going to come in and think about solving the COVID crisis and not doing things to upend the economy, which I think some people think raising taxes might upend the economy. And there are some other different policies that might be, you know, big spending on climate change might be a game changer. But he's not going to do that until we are on more solid footing as an economy. So that really buys you, and I don't think any of us figure we're going to be out of this in a quarter. So that's going to buy a fair amount of time before any of these big policy changes really start to get enacted. So I see the high yield market just voting with their money on predictability, clarity, stability. If Trump ends up winning, that's when I worry about the high yield market, because I think that brings in so much unpredictability about what policy looks like if there is no election that he has to be beholden to.
Good points. And I think that's a good transition to Monica as well, because one of the things I worry about for IG investors in particular, the IG credits, is just the campaign promise to raise both individual and corporate taxes. So we've seen IG companies really benefit from the lower tax rates, but he wants to raise this back to 28%, so not all the way to where it was. How do you think this move would impact IG, Monica?
Yeah. Well, I think you can look at it two ways. Obviously, higher taxes are not good for corporate entities. I think they would all prefer to pay lower taxes. But on the flip side, if you look to see what lower taxes actually did and who they benefited, it was more the equity holders than the credit holders. So most of the tax savings went to the equity holders. So I think if, so first of all, Biden would need to get elected. Second of all, he would need to get his tax proposals through. So that's a big if, but let's assume that he does. I mean, my base case is that it would probably be a neutral situation for the corporate market, because I think, like I said, the focus has really been on equity holders. The benefit is trickled down to equity holders. And if dividends get increased, the tax rate on dividends gets increased, I think companies may cut back on the amount of dividend increases that they have done. And I think, perhaps it could be a net neutral situation. But I also, I completely agree with everyone on the panel here about, I think the most important thing is to get over this election and to get a clear winner. I think the idea of having a contested race, not accepting what the actual outcome is, would be a huge disruptor to the market. But in fact, probably a really good buying opportunity because of the situation we find ourselves in with the Fed and just kind of investors' ability to invest in markets that have any kind of yield. And if you look outside of the U.S., the U.S. market really is the only place in terms of a developed market. Anupam, I would EM's a little bit different, but if you look at Europe and Japan, the U.S. market is really the only place where you can get any yield. So I think if there was some disruption in the market because we didn't get clarity right away, it would be a buying opportunity.
So it seems, just to sum up everyone's views, any backup is a buying opportunity, which is definitely probably going to keep a lid on just how wide we could go. All right, so thank you for that. Let's switch gears a little bit and talk about another topic that was not mentioned on the previous panel, but it's ESG. And it seems like ESG was very much in focus. COVID hit, took a pause, and now it's back. I wanted to go through each person and get your take on how ESG develops. Is it here to stay? And how is your firm incorporating ESG into what you do? So Elaine, let's start with you. We've spoken about how it has become a bigger focus for Loomis, and you've mentioned that investors are now almost demanding an ESG view. How do you think these mandates are going to be incorporated into portfolios?
Well, so Erin, what I think right now where we're at a little bit of a tipping point here. What we're seeing is we've been incorporating ESG into our research work for years, but now everybody wants the data and wants us to report on it. The regulators, specifically outside the US, are increasing their demands. It feels like we get a new phone call every week with some other list we have to comply to or rule we have to comply to, and they're continuously changing the rules. And investors are starting to make the demands, both from that regulatory perspective, but also saying, you know, this is the direction we're going in. So the trend is clear. What's not clear is what the rules are, what the definitions are, you know, what makes a product an ESG product. If I asked 10 people would give me 10 different answers. What I really watch for is when I can ask all these investors and all these people that are asking for something from an ESG perspective and demanding all this of us, when I can ask them all, but are you willing to give up performance? And I'm not saying you have to give up performance to invest ESG, but just, are you willing to give up performance for an ESG mandate? When they start saying yes, that's when we're really going to start to see it in the pricing. And once it starts to show up in the pricing of securities, it almost becomes a moot point. You no longer will be giving up performance because it'll kind of self-correct. So that's what I'm watching the most closely, you know, and talking to our traders, talking to different market makers. It seems like we're hitting that in the most obvious. You know, coal gets punished because more and more investors just plain can't invest in coal. But we're not going kind of that next level. And that's, to me, when we're going to get there. I think Europe is on their way to being there within the next probably year to 2 years. The US, you know, the same way we're 2 weeks behind in COVID, maybe we're 2 years behind in ESG. But I think we develop pretty quickly, and it doesn't take quite that long.
Thanks. So Samantha, are you seeing similar interest on the loan side from both the investors, and is it something that borrowers are embracing?
Yeah, absolutely. Just back to your original question, it is absolutely here to stay. I'm just still laughing at Elaine's analogy. I love it. And clearly, Ares has ESG has been a big factor in the last few years for us. As an organization, we're becoming more systematic and thorough in our approach, including UNPR signatories, expanding our own work, and really leveraging off third-party data. Because as Elaine was saying, there's negative screening with industries, right? No coal, some prefer no private prisons, et cetera, no weapons. But really to get that full picture of when we do our underwriting, we have a checklist of things that we're looking for. And it's been part of our process to include ESG factors, and having both internal and external resources has been, much easier for us in terms of getting a handle on what we're buying. But like Elaine said, it's been interesting because now investors want that data. It has been more important in Europe, for our investors in Australia, and it's definitely picked up in the US. And at the same time, Erin, your question is to borrowers, of course. We've seen this tipping point, as Elaine mentioned. It's become really important to corporate America. So it's been, I don't think it ever took a pause, by the way, during COVID, right? It even accelerated. So I think it's here to stay, and it's definitely going to accelerate.
Thanks. And Monica, let's go to IG and what you're seeing. I know green bonds have certainly been in vogue this year, and we've seen more of those. But what else are you seeing on the IG side of things?
Right. Well, I think we started incorporating it into our research process about 3 years ago, and so it's just one of the factors that we look at when we're looking at credits. And I would say we use it more as kind of a risk mitigant at the moment. We do have clients, and to Samantha's point, it really comes from, I think Europe is well ahead of where the US is. We do have European clients that we have specific blacklists. So they're companies that they've specified that we cannot purchase. They tend to be in, the industries that you would expect. But we don't have a specific ESG product. And again, we use it more as it's just one other element that we look at when we're looking at a credit. And what I've found is that if you find companies with high ESG scores, it does just tend to introduce a little bit less volatility into their business profiles, into how the bonds trade. And I would imagine that there's going to be a continued interest in the entire space. I mean, it's something that I'm super passionate about, just from a humanistic level. And you know, perhaps that's one of the reasons why energy is not doing as well as other sectors. I mean, it has its own issues, but you know, longer term, if you look at, you know, the secular trends for fossil fuels, I would argue it's probably not good. And I think because people are concerned about the environment and they want some alternative to fossil fuels. So again, really more of a risk mitigant and looking at it to dampen volatility.
Thanks. So Anupam, everyone here has said that Europe is a couple years ahead of the US. So we kind of know where those two regions rank versus each other, but what are you seeing from both EM investors and borrowers? Is ESG part of the discussion or not quite yet?
Great question. No, it clearly is a part of the discussion, and I think from like Elaine highlighted and some other panelists, listen, there's no standardized approach, be it within issuers or investors, as to what is considered ESG, what is considered impact investing, and those are clear, you know, differentiating factors. As EM investors, we've always had to assess, you know, countries on their social and governance standards, right? So that's always been part of our fundamental research analysis and our broader relative value framework. I think environment is beginning to take an increasing role in some of those discussions. At Nuveen Responsible Investing, you know, we have a 50-year legacy. The entire fixed income platform and all of the asset base actually follows 3 responsible investing sort of values, what we like to call it, which is ESG is integrated, and our research analysts provide a ESG rating for each company and country, which is proprietary. And because, like you said, there's no standardized framework, and we like to create a difference and assess ESG performance within, for example, for companies within their industry, so to create a neutral benchmark, and for countries within the income brackets, because you can't expect a lower income country to have the same ESG standards as a higher income country, because it's still has other needs, but within its income grouping, can it still be a leader? And I think that's really relevant. So, you know, and the other thing what we have seen is the other concept, the other value is really ESG engagement. And we've seen EM issuers are extremely amenable when we engage with them on perfect example, a couple South African miners we were dealing with, and they had some community related issues and one had labor related issues. And when we engaged with them, they were able to actually resolve to a better outcome. So that's a positive thing. And finally, the impact side. And I think the impact side where we can have positive, direct and measurable impact, you know, around environment and social issues. And now UN has set these SDG goals for countries. So I think what COVID has laid bare, if anything, has been how important, right? It was perverse in a way because it impacted not only the poorer sectors of the population within countries, but also the poorer countries amongst the countries. And so really it is imperative for the global community, we think multilateral organization, private investors and governments to come together to come up with sustainable solutions. And I think that is the part of the market in sustainable finance, which we are seeing rapid growth in. We actually just past COVID, we had Egypt issue a green bond. We had Guatemala issue a sustainable bond. So I think that growth, so yes, EM is behind, but I think it's also ripe for opportunity in terms of how much impact the investors can have and how much impact those government and issuers themselves can have.
Great, those are great points. And I like to hear that you're helping influence the issuers and help resolve some of these problems. So we are almost out of time, and I just wanted to get a quick wrap up from everyone. Could you please each give me maybe like 1 or 2 sentences on your views for your asset classes? So let's start with IG, Monica.
Sure. So I wish spreads were wider. I wish duration was less, but the market is what it is. My biggest concern really is in valuations, both in terms of spreads, although arguably we're kind of at average levels in terms of the lowest yields we've ever seen in history. Really, that goes back to what's going on in the treasury market, and then the interest rate risk that the asset class has. So I would welcome a little bit more volatility in order to have more opportunity to pick up credits at better prices. I worry about what the returns are going forward when we're starting at such a low yielding environment.
Thanks. Elaine on high yield.
So I agree with what Monica said. I wish yields were higher, but at least high yield yields are higher than investment grade yields. So we have some wiggle room. The yield on high yield is about 5.5%. The majority of that is spread. You know, it's 4 and change of that is spread. So I still think that there's potential for spread tightening. The technicals are good. There's cash in the market. The Fed's built a floor and said, I'll buy. And the fundamentals are getting better as we reopen. I do think we will continue to reopen, but it might be in fits and starts over the next quarter. But we have fiscal stimulus coming. It might not be as big as a Democratic sweep, but we have fiscal stimulus coming. So technicals good, fundamentals good, a little bit more yield and spread to deal with. Like it.
All right, Samantha, you're nodding. Let's move to you next.
Very constructive on low. You know, as the panelist said, yields are low from a historical perspective. Sorry for the echo. But on a spread basis, at 565 over, we're at 70th percentile over the last 10 years. So very attractive valuation. And given this hunt for yield, we're seeing a positive technical with institutional investors, CLOs, clearly there's an increased demand for CLOs. And we think it's still cheap. So you're getting 4.5% current. The index is sitting at 93 cents. So you actually have price appreciation. You actually have convexity. We never use that word with the loan market. And you can really, in terms of the issuers, you can choose from over 1,000 issuers and really pick the best portfolio within that opportunity set, whether it's 100 to 300 issuers. You know, you can actually build a portfolio and avoid those directly COVID hit industries if you want to. So we think we're in a pretty good spot in loans.
Thanks, Samantha. Anupam, EM. So everyone's pretty positive on their markets right now. What do you think about EM?
So I would agree with the survey. EM debt looks extremely attractive. And I think given the hunger for yield in this low nominal yield but negative real yield environment, you know, prospect for a weaker dollar, a robust recovery in China, I think those all bode extremely well for the asset class. From a valuation perspective, we look quite cheap. We haven't come back all the way in worse compared to our US counterparts, both in the US IG and US high yield market. So valuations still look attractive. I think differentiation will remain very, very important because, again, there are fiscal concerns and there are going to be political and social constraints as they always are in EM. And so I think issue by issue analysis will be very, very important within EM. From a technical perspective, you know, we saw massive outflows at the peak of the crisis. Most of them have turned into inflows. And so we're sitting at only negative 10 billion in outflows currently. And every week we continue to see robust inflows in both the hard currency and the local currency markets. So I think that along with the issuance or the primary market remaining open, really even from a technical perspective, bodes quite well for emerging markets debt, both from a hard currency and a local currency perspective.
Good. Well, thank you everyone for joining the Credit Focus panel today. We really appreciate you being here and supporting FIASI, and it was great to hear all of your views. So I'm going to turn it back over to Monica.
Thank you.
Great. Thank you very much, Erin, Elaine, Anupam, Samantha, and Monica, for sharing your thoughtful insights and perspectives on key themes we're closely watching in your asset classes. The two panels have been highly informative, and I'm sure the takeaways will lead to further discussions in the weeks ahead. We're constantly looking to bring different perspectives, so please let us know if you would like to be a speaker at future events, or you would like to recommend topics or speakers of interest in response to the survey that will follow today's conference. Talking about ESG coming back, we're hosting an ESG event on November 17th, focused on sustainable investing in the high yield sector and climate change and credit rating agency action. So the registration for that is now open. And given the growing importance of ESG in fixed income markets, FIASI is creating a platform for the exchange of views, and in that endeavor, we're looking to host a two-day conference in April 2021. And we will be looking for corporate sponsors, so please let us know if you're interested in participating by just contacting us directly or responding to our survey. Before we close out the conference today, we would like to take a moment to pay our deep respects to Wen Stephens. She's a senior corporate analyst at Credit Analyst. She was a senior corporate credit analyst at the New York Insurance Fund, who passed away this weekend. Wen overcame sizable and remarkable hurdles to achieve her career goals in fixed income, and her story about drive, perseverance, collaboration, and resilience is an inspiration to all of us. We will be paying her tribute to Wen and celebrating her life and career over the coming weeks. I would like to thank Lauren Nauser, our Executive Director, and Emily Paulino from CreditSights in coordinating this virtual event. On behalf of FIASI and our speakers, thank you very much for joining today, and have a great evening. Thank you.